bull market. It's got to end sometime. It's like we're on this crazy run.
Right.
When is it going to correct?
It does feel like we've been kind of on this extended ride upwards.
Yeah.
And, nobody can really predict the future.
Right.
But there are some signals that we can look at. And one that we hear a lot about is this thing called the KPE ratio.
Yeah, the KPE ratio. I've been seeing that everywhere. What is that all about?
So the KPE ratio, or the Shiller PE ratio, it's kind of like, think of it as like an altitude check for where the market's at. And Marco Casario, who we're learning from today on this deep dive on his podcast, he uses this. He has a podcast called Overvalued Stock Market, Smart Investment Strategies Revealed. And he talks about this KP ratio. Basically, it's just looking at the price of the S&P 500 compared to its average earnings over the last 10 years.
Okay.
Adjusted for inflation.
So it gives us a little context, like historically, how high is too high?
Well, that's the question, isn't it? And, so right now it's at a level that we've seen before, major market corrections.
Okay.
Like 1929, the dot-com bubble.
Ooh, scary times.
Yeah. So, those are...
Should we be worried?
Well,
should we sell everything?
I don't think anybody's saying sell everything, but I think it's just, a good time to be a little bit more cautious and really think about where you're putting your money.
Okay.
Because, just because the market's going up doesn't mean it's going to continue to go up.
Right. So it's not about timing the market. It sounds like it's about finding those good companies.
Exactly. And that's where Marco's really big on Peter Lynch.
Okay.
Have you heard of Peter Lynch?
Yeah.
Ran Fidelity Magellan.
Yes.
Amazing track record. And his whole thing is like, cut through the noise and understand the businesses you're investing in.
I love that.
Right. Like, don't just buy what's hot on Twitter.
Right.
Now.
Exactly. Right.
Like, really understand, what is this business? What are they doing?
Yeah.
And he always said, like, if you can't explain it to a 10-year-old in 2 minutes, you probably shouldn't own it.
That's fair. So do your research.
Yeah. Do your research.
Understand what you're buying.
Exactly.
Yeah.
And look at it that way. So, he uses this example of Chipotle. Okay. Chipotle, their stock recently dropped quite a bit. And you might look at that and be like, ooh, stay away. But if you actually look at their price to earnings ratio historically compared to the rest of the industry, it actually looks pretty good.
So it's about looking beyond the surface.
Exactly.
A little bit deeper.
A little deeper.
Than maybe just what you see on the news.
Don't just follow the herd.
Yeah.
Right.
Okay.
Think for yourself.
So then how do we avoid those pitfalls then?
What?
Where it's like everything sounds great and you're like, oh, I'm just going to throw money at AI, or,
right.
biotech is going to change the world.
Well, he talks about that too.
Okay.
Like AI, biotech, these are all, very exciting areas, but they can also be very speculative, right?
Yeah.
And so you can get caught up in these bubbles and you might make money for a while, but eventually bubbles burst.
Right.
And
what goes up must come down.
Exactly. And so, I think it's important to just be aware of that and not get caught up in the hype too much.
Don't just chase returns, basically.
Right.
You'll get burned.
You'll get burned.
Okay.
Exactly.
So how do we find those companies that aren't caught up in a bubble?
Well, he talks about looking for what he calls 10 baggers.
10 baggers, okay.
So these are companies that have the potential to grow 10 times in value.
Wow.
Which is, obviously a phenomenal return.
All right, you're not going to get that in your savings account.
No, you're not.
Okay.
And so he lays out a few things that he looks for. One is something called the PEG ratio.
PEG ratio.
So you might be familiar with the PE ratio, which is price to earnings.
Right.
The PEG ratio kind of takes that a step further and says, okay, what is the price to earnings, but also relative to the expected earnings growth?
Oh, okay. So it's not just what they're earning now, it's what they could be earning.
Exactly. So it's forward-looking.
Interesting.
Right. So a low PEG ratio can be a sign that a company is undervalued relative to its growth potential.
Okay. I'm going to have to look more into that.
Yeah, it's an interesting one.
PEG ratio. Okay.
And then, of course, you always want to look at the balance sheet.
The balance sheet. Okay.
Right.
Because
make sure they're not in too much debt.
Exactly. Like a company might look really good on paper, like, oh, they're growing, their sales are through the roof. Mm-hmm. But then you look at their balance sheet and they're drowning in debt.
Yeah. And that's not going to be good for very long. No, it's not sustainable.
Right.
So Marco's a big believer in looking at the debt to equity ratio.
Debt to equity. Okay.
Which basically just tells you how much of the company's financing is coming from debt versus equity.
Got it. Okay.
So you want to see a low debt to equity ratio, ideally.
Low debt to equity. Got it.
And then beyond the financials, he also talks about the importance of operational efficiency. So looking at things like sales growth, inventory turnover.
What's inventory turnover?
So basically, how quickly are they moving their products?
Okay.
Right. So like he uses the example of Nike. If Nike has a ton of shoes just sitting in warehouses, that's not a good sign.
Getting dusty.
Yeah. It means that they're not selling those shoes and they might have to discount them eventually, which hurts their profits.
So there are clues there, even if the company looks really good, like on paper, in terms of their financials. If you dig deeper and you see, oh, their inventory's piled up.
Exactly. It's like a little...
What's a warning sign?
Red flag.
Red flag, okay.
Right. And then, even if you find a great company, the question is, what's a good price to pay for it?
Right.
And he uses the example of NVIDIA. So NVIDIA is obviously a fantastic company, leader in, the chip space, but their valuation right now is very high.
Okay.
So the question is, are they going to be able to grow fast enough to justify that valuation?
So you're not just betting on the company, you're betting on them, like, outperform everybody's expectations.
Exactly.
Which is a big ask.
It is a big ask.
Yeah.
And so that's where it comes back to discipline. Having a strategy and sticking to it even when things are crazy in the market.
Because it gets emotional.
Oh, it does.
You see all this green and you're like, oh, I got to get in. Or you see red and you're like, oh my gosh, I got to get out.
Exactly. And that's when people make bad decisions.
Right.
When they're driven by fear or greed.
Fear and greed. Yeah, the two big ones.
That's it. That's Wall Street.
Okay. So we have to be smarter than that.
We do. We have to be more disciplined than that.
Okay. I like it.
Yeah.
So how do we do that? Be smarter, more disciplined.
Right. It's tough.
It's not easy.
No, it takes practice.
Yeah.
But, I think one of the things that Marco talks about is that the most successful investors aren't necessarily the ones who are like, chasing every hot stock tip. They're the ones who can kind of like tune out the noise and focus on their long-term goals.
Block out the noise. Okay.
Yeah. And Peter Lynch actually had this concept that I always thought was really interesting. He called it your circle of competence.
Circle of competence. Okay. What's that?
So his whole thing was like, as an investor, you should really focus on investing in industries and businesses that you understand.
Okay.
Right? So like, if you're an expert in the tech industry, for example, you're going to be much better at identifying which tech companies are actually innovative.
Right.
And which ones are just like, chasing a trend.
Following the herd.
Exactly.
Yeah.
So, it's about using your knowledge to your advantage.
I like that.
Yeah. And sometimes doing nothing is actually the best thing you can do. Yeah. I mean, there's this stat out there that like if you missed the 10 best trading days in the market over the last like 30 years, your returns would be significantly lower.
Oh, wow.
Right.
Yeah.
So like trying to time the market perfectly.
Yeah. Buy low, sell high.
Exactly. It's incredibly difficult.
It's impossible.
Yeah. And most of the time people end up doing the opposite.
Buy high, sell low.
They buy high and they sell low.
Oh, no, the worst.
Driven by fear.
So if someone's listening to this and they're like, man, the market's overvalued, what do I do? Should they sell everything? What's the one piece of advice you would give them?
I would say don't panic.
Don't panic, Bubba.
Don't make any like rash decisions based on, what you're hearing in the news or,
Fear or greed.
Exactly.
Right.
Focus on finding great businesses that have solid fundamentals, a long track record of success, and, invest in what you understand.
Yeah.
Be patient.
Be patient.
And let the power of compounding work its magic over the long term.
It's a long game.
It is a long game.
Plant that tree and leave it alone.
Exactly.
Right.
Don't dig it up every time.
Dig it up.
The weather gets bad.
I like
I
it.
agree.
Well, this has been great. I've learned a lot. Hopefully everyone listening has learned some things they can take away and really, up their investing game as we go into what looks like it could be a volatile time.
It definitely could be.
Yeah, so
be prepared.
Be prepared, do your research, and we'll see you next time. Thanks for listening, everybody.
Thanks.